Welcome to Capital Minds webinar on hedging your portfolio for Brexit and such events. Deepak Shenoy here. There's Vashitha as well. Vashitha, if you're in, you can say hi. I think your mic, okay, your mic isn't enabled. Let me just set it up right now. You should be able to both see the presentation and do this. Give me a second. I'm just going to enable Vashish's mic as well. Um, Okay, it's taking a little bit of time, but Vashisht is here as well, and I will cover the rest of this session on what we'll speak about. So, the large concept that we've been hearing along for the last few days is about Brexit. Brexit is essentially um, yeah, sorry, attenuate the high frequencies. Jackie, I don't know how to do that. I will try and figure out if I can. I can't remove the high frequencies right now because apparently it mixes with the voice. So you're going to cut off the voice audio as well if you attenuate completely the high frequencies. We had another mic, but because of today we don't have that mic available right now. That's a much better mic. So when from the next webinar onwards, it will be much better. So for now, we'll just use this. Okay. Uh, so okay, here you go. Uh, I have Vashisht as well. Vashisht, if you're here, I think you can speak now. You should be
Hi,
able
can
to
you hear me?
get through.
Hello?
Brilliant. Okay. Yeah, I can hear you.
All right. I'm going to keep myself muted because there's a lot of construction noise near my place.
Cool. Okay. Thanks, Jackie. Yes, I think that's a good idea to cut the high frequencies at your end. Vashisht is here as well. So, okay. So, here's what we're going to speak about in this session. We have this whole drama about Brexit. What is it? Will this kill everything? Are you supposed to go hide in hills somewhere? Um, I don't know if I have all the answers. All I know is that I have some answers. Uh, and if you're really worried, there is this way you can hedge your portfolio, and there is a lot of things we need to learn when we talk about hedging, about specifically about what beta is, how to calculate it at a portfolio level, finding out how much you want to hedge using this calculation. uh, in the middle, we're going to have a pain threshold calculation that I want you to consider as well. We're going to use options, put options, vertical spreads, using calls in the mix of the hedge as well, and long-term options. So there are four different kinds of hedging that we're talking about. Of course, the best way to not lose money is to sell everything and put it in the bank. That is not something we are recommending in this. We are assuming you want to continue holding your stocks, but you still want to hedge your portfolio for an event like Brexit. There is also times when you should not hedge. One of them is, one of them is perhaps now, but we'll come to that as we go along. Firstly, what's Brexit? Now, this is more macroish. Britain's exit from the EU is Brexit. It started with Grexit, which was about Greece's exit from the EU. Now there's Brexit, there's Frexit, which is France's exit, and there is a bunch of stuff that's happening over here. Um, Hang on, I think I might have lost you there. Okay, so one of the things that we'd like to talk about is that how Britain. Okay, yeah, I give me a second. I'm just going to reset my internet connection so that we'll just use a different connection. Just make sure that. Okay, just waiting. Give me a couple of seconds. Okay, we should be back. Luckily, this software didn't disconnect all of us. Great. So, am I still around? I hope I am. Been 6 minutes, so I don't think I should have gotten disconnected completely. Uh, okay. Yeah. Okay, so Britain is part of the EU, but it's not part of the Eurozone because Britain continues to have the pound as a currency. So, Eurozone is essentially where the euro is the currency. It's typically Germany, France, Italy, Greece, bunch of countries. Now includes Poland and Hungary as well. But the or I don't know about Poland and Hungary, but the idea here is that these all these countries share a common currency called the euro, but Britain is part of the EU, which is more a broader set of nations that comprise the European nations. So this EU actually allows people in Britain to freely travel to other EU zone, EU countries without having to need visas, work permits, and so on. It also allows people from the EU to come to Europe, to come to Britain and work. It also allows a common duty structure, so there is no duty that applies across these nations. A lot of items are off the duty list completely, so that they don't have to do a lot of tax work in order to export and import from these countries. More like a larger free trade area. Because Britain is part of this EU, it pays into the EU budget as well. So the EU budget, as you know, the eurozone is got a bunch of countries that have been in trouble. Like there have been Greece, which had serious budgetary issues. The ECB had to buy its bonds. There is a bunch of other things that happen within the EU which are not beneficial to Britain, but Britain will still pay into the EU for this larger market access that they receive. They also, there's also this labor simplification, tax simplification, and so on. So it's complex in the sense that if a British retiree, to give you an example, if somebody is retired in Britain and is a British citizen and goes and decides to live the rest of his retired life in Spain, gets pensions in the UK, there is a substantial tax simplification. There's no withholding tax, and they can access their money easily, and so on. Now one of the things that they've been talking about is that Britain is paying so much and getting very little in return. It does not have a whole lot of control over the policies of the EU because it's not a eurozone country. So the eurozone countries tend to have a much larger hold. Britain pays a very high amount relatively into the EU for very little control. So if there is, for instance, a law that says you cannot protect your steel plants, that is the law that currently exists in the EU. So Tata Steel, which was having a lot of trouble in the UK because it had all these steel factories, they had so many thousands of jobs that they had to lay off. The British government could not launch a rescue plan in any way. In India, for instance, you might see that the government says, okay, we'll go buy a stake in, or we'll give them some concessions in steel companies. They have raised import duties of steel in India to protect the steel companies. There is no such action that can be taken unilaterally by Britain as long as it's part of the EU. Therefore, it loses a bit of its freedom in a way. If you think about it, its sovereignty. A lot of the talk about Britain's exit from the EU is about sovereignty, about their idea that their parliament is supreme to their own country. That means anything that their parliament decides should be applicable to their country. Right now, it's not the case because they have to follow EU rules. They do get dragged down because now the EU is a larger country. The growth rate of Britain is more like the US. It's an independent currency, it's an independent country. So it's going and trying to get away from its recessionary past of the recent past. Its unemployment is down, it's starting to recover. However, countries like France and Italy and perhaps the smaller nations like Greece are not doing much. They have tremendous overhang of debt. There is perhaps a lot more crisis situations that will happen. Britain is likely to have to pay for some of this, and in return, it will have labor refugees in a way from these countries that might want to migrate to the UK and they can't do anything about it. Britain's very, very concerned about immigration. You can see about the way they've kept on raising the duties that go into visas and the restrictions they place on Indians coming there. India is not part of the EU, so obviously they can do whatever they want for Indians. They can't do a similar restriction for EU countries right now. They want to now say, listen, we want to do this. We want our sovereignty to remain. Therefore, we'll get out of the EU. The counter argument is that if they go out of the EU, they will lose all this market access. They will have to go and pay duties if they export stuff to these countries, to the EU countries. Labor travel will not be easy. So if I go in, I can't just go suddenly go and live in Spain. I'll have to apply for a visa if I'm a British resident, and that visa can be short term. So I may not be able to buy a house and live there for a long time, which is currently allowed. These are arguments that are happening, and in general, the whole world is concerned. If Britain exits, what happens? This is a referendum. Okay, so the people of the UK are actually voting for whether they want to stay or do not want to stay. If they want to stay, nothing changes. If they don't want to stay, nothing changes right now. They will take about 2 years to be able to completely exit the EU because they have to start the process of exiting, saying, okay, we want to exit. Then they will say, okay, this is the process of doing this exit. So, what all markets do you have access to currently? You will no longer have access to them. So, then Britain will go to Germany and say, okay, I still want to continue to have access to your market. What can we do together? So, Britain will make a deal with Germany, then make a deal with France, with Greece. It will work with every individual country. Perhaps some countries will join up together and kind of make a deal with Britain. But in general, we expect that a lot of the current rules will carry on for at least 3 4 years before something dramatic changes. There is a lot of concern about how people will continue to stay employed within London if they are, for instance, in otherwise located in Europe. London is a big financial hub and it finances most of the world. Unlike what we think is it's all Wall Street, but a large amount of the world finances happen through London. Although they are dollar denominated loans, they may be actually created in London, syndicated with banks like Goldman Sachs or Bank of America and Deutsche Bank, and all of them participating in a syndicated loan that is created in London, which is a world financial center. So they will this activity may be more difficult if there is a Brexit. But I believe that if this is the case, there will be a set of negotiations that kind of help these financial transactions to remain. The world will not get over in a minute. They will always take time for this, and it will be negotiated so that there is no upheaval in this part of a process. They could also do a Norway, and Norway is also not part of the EU and still semi part of the EU. It also pays a little bit into the EU budget. It gets a little bit of market access. It's like, halfway as a step into the process. The difference largely is that Norway is a very large net exporting country. Britain is a large net importing country. So for Norway, it is quite important to have market access. So they are willing to give concessions because they're a net exporter in oil and fishing and so on. This is not the same case with Britain, where they largely are a net importer, and therefore they might not want as many concessions and market access as they have to give to other nations in return. So there is a little bit of consternation there about whether they can do a Norway or not. There are lots of issues. The pound is already falling, and we have seen that in the last few days. I'll show you a chart of the pound versus the rupee versus the other currencies. There is also the issue that your market access may be diminished within from Europe to Britain. So some of the players around in Europe are now thinking that, listen, if Britain can leave, then why can't we leave as well? Can France leave? Can Austria leave? None of them may now want to leave right now, but in a lot of these countries, there's this feeling that, especially in Holland, perhaps in countries like Portugal as well, there is a lot of fear that the right wing parties may come in that say, if Britain's leaving, we want to leave too. Greece even elected a government like this, but because Greece was in the stranglehold of this so much debt, that this new party which had come to power on the basis that they would get out of the eurozone has not been able to fulfill that because they had their high hands tied behind their back. So this may not be allowed in, for instance, in a larger country like Italy or France or any of these nations where the ECB cannot really dictate terms. Greece is really small; they can squeeze them and they can tell them you have to do this, otherwise we will withdraw all the funding. You can't go to some of these larger countries like Spain or France or tell them such a thing. There is also the fear that Germany is a substantial power in the EU and in the eurozone. Britain was one of the counterbalancing forces in terms of size. Not so much in terms of rules and regulations, but in terms of size. So, if Britain goes away, Germany becomes relatively even more powerful than the other European nations. So there may be this fear that says, well, you know what, if they're leaving, let's just go, let's just set up on our own because we'll just have to listen to Germany for everything that we do. This is a fear that will perhaps lead, and it may not necessarily do so now, but it may lead to the breakup of the EU or the Eurozone. And that is not something that the countries currently want because it is an upheaval of mega magnitude. This is a fear that has triggered a lot of short positions perhaps in the market, and there's been a bit of volatility. But this is nothing. I mean, usually events like this have much higher volatility. However, um, as you can see, there is a lot of issues that is happening with the pound. You can see the pound is moving, you know, pretty much down from for the last few days, and you can see that this is not the case with the yen. The yen is actually rising, and the dollar is kind of flat, rising a little bit to about 7,000. I mean, sorry, 667. And we've got the euro that's flat. So the Britain pound fall is actually good for Britain's longer term, hopes of being an exporter perhaps, but it hurts them right now because they are a net importer. So like India, they hurt when their currency falls. Um, so the rupee pound falling really in this case means that the rupee is getting stronger against the pound. So in relativity, the rupee is much stronger. Coming to what's happening, there's a Brexit, there's yen appreciation. China has just been trying to devalue the yuan. There's so many events that are happening, and the markets are relatively benign. Okay, you're sitting with this zero point 0.1 0.2% range on a daily basis. Perhaps one day you'll get a 1% move. Very rarely do you get a 2% move. How do you hedge the downside? How do you ensure that your portfolio doesn't lose money when the markets crash? Now we'll come to that part. Okay, so before we do that, we're going to calculate something called a beta. A beta is essentially something that tells you how related your portfolio is to the market. I'll come to reasons why you need it later. But let's assume that your index, Nifty or the Sensex, whichever you want to choose, moves by 1%. How much does your stock move or a stock move? If it moves by say 1.4%, Nifty moves up 1%, this stock moves up 1.4%, the beta is 1.4. It is a number that tends to be positive. It is always going to be positive, whether and you want to see whether it moves more or less than the Nifty when the Nifty moves. So there is a link that I've given here. I'll send this over to you as well. You can see it in a recorded part of this webinar as well. That the product, I mean the link itself has an Excel file which has the beta of all the Nifty 100 stocks. So if you look at the beta of ACC here, it's 0.74. R2 is R squared, so it's about how trustworthy that beta is. But you kind of let's ignore that for now. So you got Adani Ports, which has a 1.38. That means when the market moves, Nifty moves 1%, this moves 1.38%, and so on. So BHEL, BPCL, Bharti Infratel, and Bharti Airtel. So all of them have different betas. This beta is actually calculated in a very interesting way, and we'll go through that. Let's first learn about how do you calculate the beta. In mathematical terms, the idea is, you take all the values of the stock you have, and I'll show you. Okay, here you go. I hope you can see my screen. Okay, I know that this probably is a little wide. Okay, tell me if you can't see the screen. Okay, if you can't see the screen, just point it on the right hand side. If you can, just say yes. If we have plotted the values of the Nifty all the way for one stock called Repco Home. Okay, Repco Home Finance, which is not part of the Nifty Top 100. So you can see how this is calculated. So you got your bunch of Nifty values, and this is the change from the previous day. So you look at the change of this from the previous day is this number. So this on this particular day, 16th March 2016. Okay, you can see the screen. Okay, cool. Okay, so there's 16th March 2015. It's 16. You got 7498 on the Nifty, which moved up 0.51%. Repco Home on the same day was at 582.6 and it moved up 1.33%. We've got all the percentages here, right? So you got column E, which is the percentage change, daily percentage change of the Nifty, column F, which is the daily percentage change of the Repco Home stock. The beta, therefore, is just a formula that says covariance of the two series. These two series, there's something called covariance. I'll come to that. Divided by the variance of the stock itself. What is the covariance? The covariance is, so first we'll talk about variance. Variance means I'll take this column, I'll find the average return. Okay, so average is 0.07%, and the 0.07% is the average daily return for Repco Home. This is 0.8%. How much is its variance from the average? You got 0.07% as the average and 0.8% here. So 0.73% will be the variance of this day. Then there's a variance of this day and this day and this day and so on. The mean of that is the variance for Repco Home stock. The covariance is you take the variance here and for each day and the variance here for each day and multiply them by each other. So this may be 0.73% and this will be maybe the average over here is okay 0.00%. Wow, that's fantastic. So the average Nifty move is 0% for this time. It's gone up, it's gone down, but on an average it's moved 0%. So literally everything you've seen on a move basis, it's not happened. So I think it's also because it was 8140, yes, 1 year ago, and it's about 8224. I mean 8140 today, 8224 last year. So essentially the movement has been nothing, very little to speak of. So the covariance is just multiply those two variances together, add them all up and divide by the entire number count. So that gives you the average variance of the two numbers. So it's called the covariance. So what you do is you take the covariance and then divide by variance, you find beta. The reason I'm saying this is because if you want to do it manually, that's how you would do it. In Excel, you just use the covar and var formulas. Let me go back into this. So you can see all the symbols of the Nifty in a sample portfolio that we have. We've created one which had 50 shares of each. I'll come back to how this is calculated, but I might as well do this right now before I stop sharing the screen. These 50 shares of each company, so I got HDFC Bank, IndusInd Bank, Sun Pharma, Tata Motors, Maruti, Vedel, Vedanta, Concor, all of these stocks. We just bought 50 of each, okay? The allocation is different. Therefore, the percentage of allocation is different. So I have got a sum of about 100%, out of which 9% is to Bajaj Finserv, 11% is to TCS, 18% is to Maruti, 5% is to HDFC Bank, and so on. So that's the allocation. The beta of these stocks we have already calculated either by the tables that are given by Nifty, or we have hand calculated them for other stocks. You multiply these two, 5.3% by 0.59. So you see these two numbers multiplied. You add all this up. This is the beta of your entire portfolio. That means if Nifty went up 1%, it's possible that PFC would go up 1.44%, or that Dabur would go up only 0.65%. But if you add up all the changes in your portfolio, it's likely that your portfolio will go up as a whole. Your portfolio was worth 11 lakhs 4,875. It will go up only 0.9%. So it may go up only by about 9,000 rupees, 9,500 rupees. That is the difference. So Nifty went up 1%, you went up 0.9% at a portfolio level. This is the portfolio beta. It's very important to understand what it is, because that's going to be very useful for us to understand how much to hedge. Okay, so the beta is the covariance of the stock. This presentation is fully visible, right? Okay, so we've got beta being the covariance divided by the variance. The covariance essentially tells us how two stocks move together. Variance is just the squared distances from the mean. It's not just the distances, the squared distances from the mean of an index or of a stock. So once we've calculated the beta and the portfolio beta, we have seen how the portfolio beta works. Now, how much to hedge? Portfolio beta is 0.9. We've said that. 1% move in the index is 0.9% move in your portfolio as a whole. Your portfolio size was 11 lakh rupees. So therefore, I can't hedge each stock. Repco Home does not have a way to hedge because it's not in futures and options. HDFC may have ways to hedge, but HDFC options may not be very liquid. Sun Pharma options are there, but they're not very liquid. Anyways, you need some way to hedge this. So what we do is we know that there are two options that are okay. Sorry. Oh, okay. It's on my bad. It's the variance of the index, not of the variance of the stock. So let me just see this. This should actually be my bad here. Okay. Yeah, that's about how much it seems to be. So this is index and not stock. Sorry, apologies for that. So I'm going to go back in here. Okay, so we've got 0.9 as the portfolio beta calculated in a similar way. We've got a 1% move in the index being 0.9% move in the portfolio. You've got 11 lakhs in the portfolio. 0.9% of that is approximately 9 lakh 90,000 rupees. That's the hedge you need. So I am not going to take a hedge on the individual stocks. I have 20 stocks. I'm not going to sit and take options on each of them. They're illiquid. We don't know where there's volume. There's some of them don't even have options. So there's no point trying to do individual stock options. We'll take the portfolio as a whole. We know the beta of the whole portfolio. Now we will say a hedge is needed on the Nifty. So I am going to hedge the Nifty of value of 9,90,000 rupees. Now one contract, one lot of 75 Nifty at 8,200 Nifty is about 6,15,000. So I need 9,90,000 divided by 6,15,000, which is 1.6 lots of Nifty. Now bear with me because you can't buy 1.6 lots of anything. Either it's one lot or two lots. So now we will use options to try and figure out how much to hedge. What to buy and what to hedge. we're going to use an option where there's a Greek called a delta. Rahul asked if I have non-index stock, will be a good idea to hedge against index. Yes, of course. I mean, the idea is if they have a decent correlation to the index, you have to actually look at whether the stocks are correlated. It only makes sense if your stocks are reasonably correlated with the index. Uh, in India, we actually have very little options. It doesn't matter if it's correlated or not because if it's not correlated, there is no other option available. So you can't hedge other than by using the index. One thing you can do is use a correlation matrix to find out which stocks are highly correlated and which are not. Hedge only the highly correlated ones and leave the others to leave unhedged in a way, or use an assumption saying, okay, I'll assume at least 30%, 40%, 50% correlation, and I will assume that they are not going to be I'm going to not have 50% correlation. That's the only way to deal with this, because we only have two indexes that have any level of liquidity in options, Bank Nifty and Nifty. When liquidity comes into the other indexes, and hopefully if we have a 500 index like a CNX 500, that time I believe we will have a lot less issues with correlation, because a lot of stocks will get correlated to the CNX 500, or it's called the Nifty 500 now. But right now there are no futures, no options on this CNX 500. Either that or they're not very well traded. Um, you'd find an index which there is a good correlation with. In the US, you get at least three good big indexes: the Nasdaq, QQQs, the SPX or the SPY, and the Dow Jones. So you'll get three different indexes to actually look at. The Dow Jones is not very heavily liquid, but the other two are in terms of options, and there's at least enough liquidity to be able to take these hedges. Then you have sub indexes. You get smaller indexes which may be in a particular sector like IT or pharma or healthcare or industrials. Each of these indexes will actually correlate much better with some portfolios rather than some others. So you can use those index futures and options to hedge, and there is enough liquidity usually in most of them. In India, you just get two, so there's not much you can do. You just use the Nifty in general. A number of the stocks that we've got are not very directly correlated with the Nifty, unfortunately. But since we only have the Nifty, we have to use that. The hedge needed, now coming back to here, is where the hedge is needed of about 9,90,000. We've determined that. We need 1.6 lots of Nifty equivalent to a hedge. Now, we can't take two lots of something. We can't take 1.6 lots of something. So we have to take two lots or three lots or one lot. What do? We're going to use options and a certain thing called a delta of an option. Let's come back to that. But what it is it's basically means how much does an option price move for a rupees 1 move in the index. A delta of 1 is present in the future. So the future moves by 1 rupee when you are long the future, and when the index moves 1 rupee typically. Delta of the future, if you're short it, is -1, because for every up move in the index, +1 move in the index, your future moves -1. So you lose 1 rupee for every 1 rupee up move. The deep in the money option, a 7,000 call today, when the index is at 8,200, is almost like a future. If it goes up 1 rupee, if the index goes up 1 rupee, the option will go up by 1 rupee, because there's very little time value left. So the delta is near about 1. Now at the money, today is 8,200 call, and at the money options are typically 0.5, which means if the stock moves by 1 rupee up, the option moves by 0.5 rupees up, or 0.1%, 0.5% or something like that. And then it won't be just rupees. I think it will be 0.5%. Doesn't make sense to have it as rupees. So you get 1.6 Nifty, you can buy two options, two lots that have 0.8 delta. So you'll buy two lots with 0.8 delta to give you this 1.6 delta that says if the Nifty moves up by 1, I will get 1.6 return on my option. I can buy 4 options with 0.4 and multiple. Let me now share my screen to show you, but before that, let me just see if I've got the next slide right. Okay. Before this, let me share options oracle in their way. It's a free tool. Hello, Amit. Uh, you can ask your question, no problem. So, if okay, options oracle is a free tool. It is a tool that allows you to be able to look at options in multiple ways. It is available online. Search for options Oracle, and then I think there's a link at Market Calls that shows you the options Oracle that currently works with the Indian exchanges. Let me just Vashisht, can you perhaps type the URL? I don't remember. Just Google for options Oracle in India or options Oracle and Market Calls. Now this is this is an interesting piece that we have. We just type in Nifty over here. It will download all the options. Yeah, there you go. Google Options Oracle PASI. There's a guy called PASI. This source code is actually available. So I have actually taken the source code, modified it a bit, but Mr. PASI has done a better job. So he's put it up online. All these options are available. I just clicked it. I hit enter, and we can look at the uh, all the options on the exchange. Now I look at only June 16. I can look at July as well, or just June. I look at June. I've got all the parameters of each option. This is a put at 8150 strike for 30th June. So I've clicked June 16. Um, I've got the how much ever there is in terms of value, time value, the bid, the ask, the volume of the option, and I've clicked this Greek button which shows me these. So without the Greek, it will just come like this. With the Greeks, it will show me the Greeks as well. The Greeks involve something called the delta. Since the Nifty is at about 8161, this is the where the Nifty is. You can see that 8150 is probably at the money. This option has a delta of the put option will have a negative delta because it will move down when the Nifty moves up. So approximately zero point 0.5 at the money. As you go deeper and deeper in the money, well, these prices are not traded, so where it's not traded, it will show you that it will tend towards 1. So 8950 has a delta of 0.75, and there's nothing traded higher than that, but as it trades, you'll see more. So this is minus 0.92 because it probably got traded later in the day. This is a 8450 option. So as you go to the 8450 put, when the Nifty is at 8150, is like 300 points in the money. So 0.92 is very close to 1. So as the Nifty moves further down, it will move up by 0.92% each time. Sorry, 0.92 points each time. So um, so here you go. Yeah, it's actually points. So Nifty 1 point is how much points move in the put. Now let me show you what it means to take the portfolio position. Now I have taken Nifty. I have taken 120 quantity of Nifty. Why? Because we've got a 9,90,000 exposure. So this is approximately 9,90,000 rupees of exposure in the Nifty. I have just added as a long stock. The reason this is Oracle options Oracle is used in the US where they don't trade index. I mean they trade stock versus options. India would have futures versus options, so there's no long stock in our case is equivalent to long future. I will then take an at the money 8100 or in fact an 8150 put option. I'll take it at 91 rupees and I will buy 2 lots. So 75 into 2 is 150. How does my graph look like? You see this as the Nifty. Yeah, here you go. Okay. Um okay, hang on. So here's the one. So the Nifty crosses. It's at 8150 now. Okay. So this tends to be, why is this so wonky? Hang on, I'll just click refresh. I'll just refresh with the latest data. Um, so I will actually, if you look at where we are today, I am buying the 8150 put for 91 rupees 35 paisa or 92 rupees. In this case, okay, the values have changed. 80, okay, here you go. 8170 is where the Nifty is at, and the 8150 is at 96 rupees. So here's what happens, okay? I'm going to show you approximately here. Okay. If the Nifty is anywhere above I have paid 91 rupees per option into 150. So nearly 14,000 rupees for my 1 lakh portfolio or 11 lakh portfolio to be hedged. I wanted a hedge for 9.9 lakh worth Nifty. I put two options at the money, two lots. I took this hedge. What happened is that at current levels, if the Nifty stays exactly where it is, I will lose 15,000 rupees approximately, because that's the amount I paid. You can see at the bottom over here that I am losing about 11, 15, 14, 16,000 rupees. As the Nifty falls further and further, my option goes deeper and deeper into the money. And at some point, I actually start making a profit because I have 150 of the call and only 120 of Nifty. So it's got a little bit higher. This actually, compensates. So I paid this much for the insurance. I was willing to lose 14,000 because I paid that much for the insurance. But the portfolio didn't lose any more money beyond, approximately 8160 or 8170. Yeah, it will not lose any further money. But this is very expensive. Why should I pay 14,000 rupees? And June is only till 30th June. We are sitting on 17th June today to 30th June. That's just 2 weeks. For 2 weeks, I'm going to pay 1.5% for my insurance, one little bit more than 1% for my insurance from now till June 30th. Brexit is on June 23rd. Yes, big things may happen. I may need it covered, but I don't want to pay 1%. I mean, 1% is like what you make in a month or maybe half a month. Why do you want to give away your entire returns for the full month, uh, or something like that, or half a month for just the fact that Brexit is happening? So you got to do something else. Let's say that we want to go a little bit further down in the game. Now I'm going back to no screen. I don't want to pay you so much money for insurance. I'm okay with small moves. 5%, 10%, I'm fine. So if Nifty falls 5% from here, I'm good. I want to protect my portfolio only beyond 5%. 5% for Nifty at 8200 is protection from 7790. So let's say 7800. You do a protective put at 7800 rupees. So that means either you buy the 7800 put, or in this case you can't buy the 7800 put only, because if you buy two lots of them you have more than you require. If you buy one lot you have less than you require, because you need 9.9 lakhs or 1.6 worth of Nifty as protection. So you use the deltas to figure out what it means to, and you can pay something like 20 rupees for 4 lots at 7700. 1.6 Nifty is 7,700, 4 lots. So I'll pay 6,000 rupees for protection for Brexit. This is a very simple way to think of hedging your portfolio. I'll work the metrics out and I'll show you how it works. This gives you 6,000 rupees cost for a 11 lakh portfolio with 0.5% as insurance, but only for 2 weeks. Much lesser than paying 1 and 1.25%. You buy 4 lots, remember. As if the Nifty falls, your deltas are going to go up, because in this case, the deltas are going to become even more deeply negative. So they may be 0.4 today, but if the Nifty falls to 7,800, then the deltas will go even higher. So your 7,700 put will see serious increase in delta. I'll show you how as well. And then you may not need 4 lots. You'll go down to 3 lots. So you'll sell one. Because the prices have gone up, you're literally booking profits. Now it fell to 7,600. You may need only 2 lots for protection. So what happens now is you sell one more lot. So at this one more lot, you booked another little bit of profit. That kind of covered a little bit of your losses, and then you covered further from there. Two lots at 7,600. Two lots off the 7,700 put. At when the Nifty is 7,600 has given you full protection on the downside further on. There is no more loss that you can ever have to bear. The Nifty goes up at any point, you don't care. You are protecting your downside. You don't want to care about your upside. So let me show you how this works. So, okay, now here you go. So we've got the Nifty. I'm going to change this to a 7,700 put. Okay. I don't know what the price is right now. It's only 14 rupees, not 20 rupees anymore. So I am going to buy four lots, 300 of them. Right. So, and their delta is my, we've changed the delta here a little bit on this side. So, okay. So we are long our portfolio, which is effectively 9.9 lakhs of Nifty using the portfolio betas, and we're going to hedge it with a long put 7,700 level because we want protection of 5% or below. What happens to the graph? Now this is how the graph looks as we go along. But let me just change this. Okay, so we are right now at 17th June. If it were to fall tomorrow, this would be the price. So the maximum you're losing, I'm just going to highlight it till here. The maximum you will lose is about 20,000. Why does it say that? 75 4s or 300 into 15 is 4,500. This doesn't make any sense. How can I lose? Oh, I will lose more because my portfolio, I'm willing to lose 5%. Remember that. So I'm willing to lose 5% of my portfolio. So 11 lakhs, I'm willing to lose 55,000 rupees. Which in a beta context of the Nifty at 9.9 lakhs is about 50,000 rupees. So I'm willing to lose up to 50,000 rupees before my protection should kick in. This protects me. There is no 50,000 rupee loss anywhere in this picture. So I can go to the maximum rate possible, and I don't think I will lose more than 50,000 rupees. So that's my maximum loss. 28, 29, 30. Okay, I have to 60,000. I forget. We have a little bit more because we have the loss on the premium paid as well. The 6,000 rupees premium that you paid for the long put, that is added. So apart from the 50,000, I have another 6,000 for that. So I will lose a little bit of that as well. This is imperfect, so as a hedge designed in a slightly different way, so you'll have a little bit up and down in terms of losses. But you lose about 60, you'll lose about 60,000. At this is on 30th June, not lose any more before that. In reality, what will happen is the losses will be lesser. Let's assume Brexit happens on 23rd, and on 24th the market falls to 7,500. Your loss is now only 18,000 rupees because the Nifty option 300 that you hold would have gotten up tremendous in price, and I'll show you how much. So if you look at the calculations of well, okay, this doesn't make any sense. We'll add the analysis. Yes. So I'm going to say I want a profit and the loss for yeah, I'm going to just say versus date. This will give me the results table for the Nifty being at the current level. I could say give me what happens if the Nifty reaches 7,500. 7,500, and here you go. So at 7,500, if I reach there on the 24th, I would have lost only 18,000 rupees. I was willing to lose 50,000. I have seen the Nifty go down from 8,200 to 7,500, 700 points. And yet, I have lost 1.5% of my portfolio, which was 11 lakh rupees. The 18,000 loss equates to about 1.5% of my portfolio. The reason is the put options that I have bought have given me that level of protection. At this point, I could say, okay, I don't need 4 level protection. I need only, and for the remaining days, I'm either going to take it off, or I'm going to say, I will say, listen, I will take off two and retain with further two lots only. So out of 300, I sell 150. They would have actually gone up in value from the current 14 rupees to about 250 rupees. So I would have sold them at 250 each. 150, when you sell at 250 each, you will get about 37,000 rupees. Um, yeah. So that 37,000 rupees is a profit. So in actuality, your portfolio itself has gone down by about 60, 70,000 rupees, but you recovered 37,000 because of this put. The 37,000 that you recovered because of the put offsets your entire thing, and your net loss is only 18,000, which is about 50. So you would have lost 55, gained 37, so net loss is only 18,000. The loss will keep increasing at 7,500 because now the option will lose all the time value as well. So the remaining time value will go to zero at 30th of June, and that's pretty much when you make the maximum loss or end loss of this game. So this is a way to look at hedging using a protective put. And you can use options oracle to model different kinds of scenarios. And for instance, I'll say, listen, at that point, why will my option IV stay at current levels? So let's say current level is 18%. Will it stay at 18%? No, no, no. If it goes down, it's going to go up a lot. So what's going to happen is maybe it will go up to 25%. Okay, because if it went down in one day, at 25%, my loss on the 24th, when the Nifty is 7,500, is even lesser. It's well, it's a little bit lesser only, but at 18, it's only going to be 17,000 or so. So if the implied volatility, why is it higher? Because now there are very few, there is a much higher option price that you can use to sell in the market and hedge out your portfolio. So as the implied volatility increases, if it ever went to 740, 45%, we haven't seen a 45% for a long time, so don't hope for that. But if it did go to 45%, even at 7,500, you're break even. You have not lost even a single rupee, including the 6,000 rupees that you paid. Even that you've recovered back. And you've got all the losses that you made in the portfolio recovered by the options itself. So implied volatility may go up. You can model that as well and on different dates. I hope that part is clear. I'm going to come back. Okay. We can, instead of doing just plain protection using puts, if the Nifty falls 5%, I'm not happy. I'm sad. I don't like it. I want a protection. But if the Nifty falls 15%, I want to buy because I don't think it's going to last. So at 8,200, I want protection, but 8,200, I want protection at 7,800, but I am a buyer at 7,000, right? If it falls to 7,000 tomorrow, I am a buyer. So you can buy protection at 7,800 and sell 7,000 puts. This reduces cost, but when you sell puts, you need to put up margin. So it's not a huge deal. For 11 lakhs, for two lots, your margin will be like 1 lakh rupees. You can put your stocks, and the broker will give you margin against the stocks, and you can use that as a margin to write your puts. Okay, before I go there, Rahul says, do I need to time it by to square off the put by or will I just lose insurance money in case volatility drops after the event? You will lose a lot of insurance money when the volatility will drop after the event. You're buying insurance. You're essentially covering yourself for that cost. So your premium could go away. It could go to 7,500 on one day. Then it could go to 7,200 the next day. So your squaring off or not squaring off is a function of whether you want further protection or not. At 7,500, you can say, okay, fine, I've got protected till here. Maybe I can take a little 100, 200 rupee more loss. So I can say I'll roll over the puts from 7,700. I'll go down to 7,300. I will set up a new barrier. So now I have another 200 points I can lose from 7.5 to 7.2, 7.3. And those 200 points I will lose further, but I will have insurance from 7,300 and below. I can do these kind of tricks, but typically what you want to do is if the event is bad, you want to set up some insurance, just work through the insurance setup and say, okay, I have achieved the goal of insurance itself, which is I protected my portfolio against losing more than 55,000 rupees. Okay, now let me go back to the screen sharing piece and I'll show you what it means when you put, when you buy, sell a 7,000 put. But remember, yeah, this is what Vashisht has also said, which is you will lose all the insurance you've paid. If you buy a flight insurance for, say, I mean, I just went to Bangkok as well. We also went as a whole family. For a 60,000 rupee ticket, we paid 1,500 rupees as insurance. I only bought it because I have kids, and if anything happens over there, I don't want to be stuck saying I don't have the money to pay for a hospital bill. Uh, I paid 1.5% for 2 weeks. And what Vashish is saying here is that you might end up paying 3.4% for 2 weeks. So that's a huge amount of money. Um, here you're paying 0.5% for your portfolio to fall beyond 5% for a period of 2 weeks. It's probably just a way you think about it. You lose that money. That 0.5% is gone. Um, you should write it off the minute you take the insurance. For the 7,500, 7,000 puts, when you sell them, if you're doing a vertical put spread, you may not get much as an offset in terms of premium now. So, for instance, today 7,000 put of June is trading at 2 rupees. So, you paid 14 rupees, you just got 2 rupees back as the premium for 7,000. But 2 rupees is a good amount in the sense that if you're doing, if you're paying 6,000 rupees, you're getting 5% of that back, 300 rupees or 300 or 400 rupees back as lesser, negative premium. So you pay only 5,600 rupees premium. You can also go to the next month. So you can go and say, okay. So we've got options Oracle. I am going to take the 7,700 put. I am also going to go to July and say I'll take the 7,000 put short. I won't do the full 300. I might do only 150, and I will go short this put at 6 rupees 90 paisa. That's a fair amount. I am getting half my premium back at 6 rupees 90 paisa. So if it goes down to that level, I am willing to kind of square it off. So you might see the graph over here, which kind of gets very complicated because at 7,000 it starts making a fairly big profit because I have a disjointed this thing. Let me just give you an example of a perfectly hedged portfolio. Okay, you take a 150 Nifty and a 150 7,700 put. This is how it will look. Okay, so your portfolio will actually be, the reason this is curved at this point, so you get this point here which is you're profitable above 8,200, you're losing some money at 7,000, and as you go lower at 7,000 onwards you're going to lose even more money because you're short 7,000 puts further. The reason this is curved like this is, and it's not flat, it's not straight, is because these are the July puts you bought, which will have time value. So even though June puts have expired at some value, July puts haven't expired, so they will still have some time value left in them. So you'll lose some more money. Here, actually, you're ending up losing 1 lakh rupees at 7,000. So your loss is higher, yet we get the opportunity to buy more at this point. So you can adjust it according to your needs. So for instance, I might say give me 225, excuse me, sorry, at this. So this will give me a profit cover that is completely covered till 7,000. From there onwards it goes down, but at this point I don't care. At this point I'll square off my insurance and just buy the Nifty because I want to buy the Nifty at 7,000. So I'll just buy more stocks when it comes to this point. So I am sitting here saying that at 7,000 I lose only 50,000 rupees. At 7,700 I'll end up losing a little more than I thought, which is 74,000 because now I have these offset issues. But it'll give me a balanced view at 7,000 as well. So this is another way to look at hedging your portfolio using vertical put spreads. This is a vertical calendar put spread because we are the 7,000 puts of a different month. The final piece that we'd like to discuss is you don't want to pay for insurance, and I think that's the one of the things that you do. Here's that you talked about. You lost all the money in insurance. अभी ये Brexit नहीं हुआ. If I didn't get Brexit, what I lost 6,000 rupees. Okay, here's the thing. Give up a little bit of the upside and cover your downside. Buy 7,800 puts at 20 rupees and finance it by selling 8,400 calls at 20 rupees. Your upside is limited, which is about 3%. So that means if it goes anywhere more than 3%, it goes beyond 8,400 from now, you're not going to make any more money because you've written the call. Downside is protected beyond 7,800. So anything from 7,800 downwards, you will not lose any money. What you paid was 20 rupees to buy the insurance. What you got was 20 rupees to get the insurance. Or rather, when you as premium when you wrote the call. So if it goes down to 7,800, the 8,400 call will go to zero. The 7,800 put will now act in your favor and give you insurance. So you have lost between current value of Nifty 8,150 and 7,800. You are willing to take that risk anyway. So that much you've lost. Anything beyond that is covered. 8,150 to 8,400 you make the full gain. Anything beyond 8,400 you do not make any further gain because you've written the calls. The calls have financed the puts. Essentially you've got a sort of a semi. What to do now is to go back into. Okay, here you go. Okay, sorry about that. I'm going to delete this and then I'm going to add a short call. So let me see, calls and of June at 8,000, something that finances this 14 rupees. What finances it? So let's see it out of the money call and we're going to look at something that is 14 rupees. Oh great, we have 8,450. Let's buy 150 of everything so that we are aware of what we're doing. Here is your graph. Okay, we went long, so we should be going short a call. Here you go. This is the profit. So I'm going to do all the way to 9,000. So you're here, your profit is perfectly fine until you reach 8,450. Beyond that, you make no more further profit. Your profit is capped. So you make your 41,000 on your portfolio, it stays at 41,000. Because anything more you gain on the portfolio, you lose in the Nifty call. Downside, you take all the downside to 7,800, anything less, 7,700 in this case. Excuse me. And then you will not lose any further money. I could change this to 7,800 as well, and then I'll have to change the upside hedge. So if I change this was at 22. So then maybe I have to change this to 8,350. I think that's also a little too much. So maybe 8,400. Yeah, here you go. 8,400 will give me a close enough cover. So I'm paying 3 rupees for this insurance. Net payment of 3 rupees, but it gives me a hedge between about 7,800 and 8,400. I'm somewhere in the middle. So it's paid for itself and I'm covered beyond 7,800. I don't expect the Nifty to go. Think about it. If Brexit doesn't happen, will the Nifty go up like 5 or 6%? I don't know. I don't think so. That's a call you'll have to take. So how much upside do you want to give up for how much downside you want to hedge is an understanding that you'll have to make. This gut feel or pain point is something that is individual. It's not something. Right. Now we also have long-term options. You can use things like December options, and next December puts are available even today. You can buy a 6,500 put, saying I don't want it to. I want full protection to December 2016. You'll get it for about 35 rupees per Nifty. It's expensive, but if you think about it, it basically gives you protection at 35 into 75, which is about 2,000 rupees for a 6 lakh portfolio. So that's about 0.3% for the whole year. But of course, it's giving you protection at 6,500. You can buy something further up and you can see which options are available. Many brokers don't make this available easily, so you may have to call up your broker to find out which are available or which are not. Do it when the VIX is lower. The deltas for much longer term portfolios are very different. So check the deltas on Options Oracle before you do any buying. And you can do the same thing. You can finance it by writing a December 9,000 call. There's not much liquidity here, so you'll have to really calculate the deltas before you enter. Okay, and finally, when should you not say hedge? Now somebody will tell you, yeah, market is going to fall. This has zero need for hedging. People will give you this gyan all the time, and some people will tell you market is going to fall for about 1 year, and then they'll tell you market is going to go up for 1 year. It doesn't mean you go and hedge every time somebody says market is going to fall. Or you get some news saying bad IIP data, bad inflation data. All this stuff is normal, it's part of the game. It is, if you can't stand the heat, you should not be in the kitchen. So there will be some heat. There will be some news that will come from nowhere and all that stuff. This coming from nowhere, you can never really hedge. What you should do is either have a constant hedging policy saying I will always have a hedge. So I will always be willing to pay 0.5% of my portfolio every single month in order to hedge my portfolio. So I will do that. I will lose 6% a year on hedging. Fine. If I have 6% outperformance from the index because of my portfolio choices or whatever, then I can pay for the hedge. So it's fine. You may have some other strategy that earns that 0.6% back. Maybe you write straddles in another portfolio, and you can use those straddle profits to finance the hedge on your portfolio. You can use the straddle itself as a hedge because it provides a natural protection. If you write a straddle, write a call and a put at 8,200 today, you'll get about 345 points. 345 points is there on both directions. So you naturally get 340 points protection if the market falls down. You can use that as a way to finance a hedge at 7,900, which protects you then from 7,900 onwards. It's 8,200 today, 7,900 is 300 points away. So 300 point protection you've got from the straddle. Further, you've gone and bought this put for maybe 35-40 rupees. So net you are completely protected on the downside. Upside is bare, but upside is where it is. So uh, you can yes, of course, Shankar Sharma is a good example, but of course he went long recently, so that's one of the reasons you might want to hedge your portfolio. That's a different thing. But there's bad IIP data, bad inflation data. Somebody said so, bad ideas to hedge. If your portfolio is less than 2 lakh rupees, ignore everything you've just heard, because it is damn difficult to hedge one. They've increased the Nifty lot size to a point where it's minimum 5 lakhs per lot. When it was 2 lakhs per lot, 2 lakh portfolio was also okay. Today, 2 lakh portfolio can't be hedged easily. It's first of all, it ends up being very messy. You have to do 0.4 delta, which will be available way far away. You will not get the right kind of context. It's just too small as a portfolio size. You won't be able to sell calls because you won't have enough margin and so on. If you hold small caps where the beta is untrustworthy, there are upper circuits, lower circuits, there's a lot of ups and downs which the beta is not, and there's a lot of lack of correlation. That apart from small caps, also lack of correlation. You should not consider a full hedge. If your betas correlations are much lower, then you should understand that your hedge will be imperfect. If your hedge is imperfect, then you're not going to get the same benefit of a hedge then as much as you thought. So you may hedge for 0.9% of your portfolio and all that stuff. Your portfolio may be down 1.5%. Nifty is down only 0.5%. What are you going to do? The problem is the betas were untrustworthy. They were not. The correlations didn't exist. There is also model failure. Okay, so correlations can break. Something that's 0.9 correlation with Nifty can suddenly fall 20% overnight because maybe some fraud has been discovered, some FDA action has happened, something else or something else. That day, you don't have any protection because your model broke. That model failure can violate the past betas that you have calculated and done this portfolio beta calculation and all that stuff. So it's imperfect, and you should know that there is a risk of this. If you're really scared of it, don't do hedges. Just leave it. I mean, you can't hedge it. So model failures will happen every once in a while, and you'll have to. The way you can handle model failure is to do different things. you create manageable hedges in a longer term. So you might actually take a nifty hedge, increase position size, decrease position size according to how your stock has reacted. Um, Lastly, of course, if you didn't understand anything we just said, this is probably not a good thing to take a hedge. If you find that options are not something that you like to take on a regular basis, you will you will find it very difficult to deal with the emotional loss as the hedge works out or does not work out. The only way to think of a hedge in this case is it's like insurance. You've lost the premium as soon as you've given it. If you don't want to lose the premium, you've written a call, you've given written off some of the upside. That's the that's the only real way to look at it. And if this makes you uncomfortable, then hedging is not really something that you should do. Never lose sleep. If you're doing stuff that is making you lose sleep, you shouldn't do it. So that comes to the end of the seminar, and I think we've got about 15 minutes left. So I've just stretched the time a little bit. I know we'll have some audio issues in the beginning. So how how do you find it? And if you have any questions, please do write them on the right. We can answer each of them. Uh, Preferably related to what we've talked about, but if you want me to repeat something or talk about something else, that's also fine. I'll wait for questions to come in. Meanwhile, we've got, so if many of you are trial members, we've got a bunch of stuff that we have at Capital Mind Premium. We've got, macronomics and option analysis, our newsletters. We're running a couple of portfolios, some long only, there's a long term, which has been doing very well recently. A short term which hasn't, because the market's been volatile a little on the downside. We're long only. We've got some things happening with options. We've got a strat options portfolio where we try to target 3% a month by using just option strategies in any market. We've managed up market and down markets. Vashisht is the boss here. We are still running it, as in we still have positions on for June as well. And we've got smart caps, which is a small portfolio that will expand. These are our customers who have identified stocks and we find them very interesting. Uh, Bunch of that, our proprietary Snap data platform. Do visit. Oh, there's capitalmind.in and the subscribe link is changed. So I'll send the new link in an email. Thank you so much for the presentation. I'll give you the software names. The software name is Options Oracle, Mahesh. I'll just type it in. You can just Google for Options Oracle Pasi, which if you do that, get you'll kind of get a full listing. We will record this presentation. I hope this has actually recording this. This whole thing is being. This is actually going to go on YouTube, and you can see the video of how to hedge and so on. Jackie, yeah, we have to very soon. Uh, well, not right now, but we will do an OO webinar. There is one OO webinar that's happening by Market Calls on tomorrow. But we will learn about how that is, and if you guys want, we'll create another webinar series only for Options Oracle. I think what will be very good is for us to run through various scenarios for options. We've got somebody raising her hand. Okay, Mr. SK Kedia, yes, please go ahead. Yeah, Options Oracle is really cool as a tool. Mr. Kedia, you can type on the right, and I will answer your question. Uh, this Options Oracle is pretty cool as a tool. You can do so many things with it. Look at the deltas. The deltas and all are like Greeks. So a lot of times you just want to see how your graph looks. If you do something that is really crazy, will you end up uh, losing money. So you create a position. You can actually save it and then come back to it later and say, okay, oh, now I've got this portfolio. It's changed to this, sorry, this payoff. Today I'm here. If I added up this particular option long and that particular option short, how would the graph change? Then you look at scenarios because you're going to combine this with some level of technical analysis and say, okay, I am seeing a resistance at this level. It's either going to stop there or it's going to break there or it's going to break it and go out. So I want protection beyond that point. So I'm going to look at the resistance and say I'll just create positions that give me an options payoff, assuming that the Nifty will kind of resist here or will have support here. You could also look at the OI graphs and look at where the players are currently positioning themselves to see where the maximum open interest is in the calls and the puts. Use the, well, it's not a very exact science, but a concept like um the Nifty is not going to go beyond 8,000 because 8,000 has so many calls and puts written. Never do this as an event. When there's an event, all this thing kind of wipes out. But in general, without an event in place, without large amount of results in place, after Brexit to June 30th, you may see that the options build up is between two certain points, and it's very likely that the Nifty doesn't move beyond those 2 points. Look also at change in option interest on a daily basis. So that tells you where today's players are moving and acting, and you can use those positions to build, hedges or actions against your portfolio. We've talked only about stock portfolios. We haven't talked about options portfolios. Hedging options portfolios is like a webinar series in itself. There's so many things you can do with it, it almost blows your mind away. But typically people own stocks and they want to hedge them, so we've kind of talked about hedging that as a concept, not hedging for instance short positions or there are many ways to do that. People say, okay, if I have 100 rupees long, I will have 40 rupees short. That's a natural hedge. So they just go long one series of stocks, go short another series of stocks. That's also a different way to hedge your portfolio. Okay. Name of a good book on options. I actually, this is where I am lost. Um, I learned about options largely by trading them and by looking at some things. The books I studied weren't very all that great, but um, so I don't know any great books offhand. Let me just try and remember. Vashish, do you have anything? Okay, I guess we'll see a bunch of. There are a lot of books, So there is I can't I can't remember right now offhand. Yeah, you know what? He's right. You should just sell an option and track it rather than you'll end up spending so much money on books. It's just crazy. I would not suggest pirating books at all. Okay, so I do not suggest that at all. But a lot of books sometimes they look good on the cover, but the material is not that deep or great inside. The practical knowledge is better. We should have a book section to kind of for people to read, but I think books are better which are more which talk about things that are slightly higher up than the basis of options and all. There's a person, there is a book for an Indian market by Ashwini Gujral. I read the book, it's very rudimentary. So you will only get the basics, the theory. The theory has very little relevance in today's world, especially when you will want to hedge for an event or something like that. You This is not really so portfolio betas, deltas, all this stuff is not really very deeply discussed. But there are books, I'm sure. I haven't read any right now. I can't point out any right now to you offhand, but I'm sure there are more. Options playbook, yes, there's that's That's available. And best thing is look at YouTube videos on options. There are a lot of very good ones. Tastytrade.com, these guys are gods. Very, very good. Just look at Tasty Trade. There is a video in which this person who runs the site, Tom Sosnoff, gets his daughter to learn options and trade them through a series of about, I think, from Jan 2013 till now. She's now become a full-fledged, she's very, very good at trading. She literally learned it on a series of videos that they did over time, and traded live as well. So you can look at that to see how these things evolve. Selling puts. Yeah, Mahesh, don't. Raghu, that's a good idea. Don't sell puts before the 23rd unless you know what you're doing. I think more importantly, you should not sell puts unless you know what you're doing. No matter what you're doing, no matter when you say it. In the US, there's a big difference between selling a put in the US and selling a put in India. In the US, they have restrictions on who can sell puts and how much money you have to put in. In India, if you want to sell a put, they won't ask you who you are. They'll just say how much money do you have. In the US, it's about who you are. Are you a small trader, big trader, intraday trader, day something trader, professional trader? You have to qualify to become some of these, and only when you qualify are you allowed to do unrestricted writing of such certain options. In India, you will not have to. So in India, when you sell a put, they just ask you for a margin, 50,000 or 60,000 rupees per lot of Nifty, sometimes lesser, actually 35,000 as well. This you just write it, you can sell the put. But what happens when you sell a put is that you end up getting some premium, and you're just betting on the fact that the market is not going to go down more than the premium that you received. That's it. That's the sum total of the argument that makes it for selling puts. Now, when should you sell a put, and why should you sell a put and not sell that put and not this put? That becomes a nuance of why you're doing what you're doing, combinations. Uh, okay. Yes. Raghu, yes, for OTM calls. Yeah, of course. Yeah. I mean, the problem really is that, far OTM. In India, it hasn't happened. Think of guy who's done a LinkedIn sell call on the day before the announcement that Microsoft was going to buy it. The stock jumped up 50%. That would not work. So sell calls will not really work on stocks. Selling options on stocks is far more risky than selling options on indexes, because a stock can move 20%. An index is not likely to move 20% in any of this, but it can happen in either direction. So, you know, extreme risk is always going to be there. That happens whether you own a stock or otherwise. If you don't want extreme risk, you should never be in the market in the first place, because there will be one day every year that there is an extreme risk. Um, but other than that, largely, and people think of always options to expiry. I don't want an option to expiry. I want a hedge for Brexit. On 24th, my hedge is gone. Because if it's not moved, if it's done what it needs to done, it's lost it's either gone 5 or 6% or 7% or something. If I don't see it falling any further, I'm going to get out of my insurance. I'm done. So if I've lost only 18,000 till then, I will lose my 18,000 and I'm out. So I don't have to actually think about what happens till expiry. So that's why I'm trying to model my stuff as in what happens on the 24th when the Brexit result is known. Cool. I think we've done 1.5 hours. I think this has been a very interesting session. I hope it was valuable to all of you. I hope you'll come back for more webinars as we drive them along. We'll send a recording by tonight or tomorrow on your email. You'll be able to access this, so you can refer to it back as well. Happy to take any more questions. You can connect to us by email. Just visit capitalmind.in, send a mail to Deepak Shenoy at capitalmind.in or support at capitalmind.in if you have any questions. If you'd like us to conduct webinars on any specific topic, please feel free to mail, connect on the Slack channel if you're a premium member, or just let us know in any way on Twitter as well. We're at capitalmind_in on Twitter, at Deepak Shenoy on Twitter, at Upticker on Twitter. We're all available. So great. Thanks very much, Jackie, Mahesh, Raghu, and all of you uh, for coming in. Have a pleasant weekend, great Friday, and I hope it doesn't rain too much where you are. Thanks for watching.